in each cycle, which is say it's between 7 to 10 years, there are about 2 years to make outsized returns, be that corporately or be that in that investment transition. That's the peak, 2 years. So you've got to be very smart, very savvy, and very specific. One of the most impressive things, and look, I've had to do it myself, so I know how hard it is to run a business while you're also out there capital raising. When you're really, really, really busy, and you've got to keep all these plates spinning, you've got to keep the existing business spinning, you've got to raise capital, you've got to think of new ideas. It's hard. I'm beginning to see that core plus capital come back into the market, and that's basically driven by capital allocation across some of these insurer pension fund groups, and then realizing that actually probably makes sense to go back into some of these markets.
Will, welcome to the People Property Place podcast.
My pleasure to be here.
Not at all. It's a real privilege, so thank you so much for joining me. You've had a fascinating career and you've worn lots of different hats throughout your tenure. But before we get on to unpacking some of those moves and justifications and views and takes on the market, can you rewind the clock and tell me, did you choose real estate or did real estate choose you?
Originally, I wanted to be a doctor. So, and that came out of other doctors in the family and who'd succeeded. Where I didn't succeed. So I got to the stage of 19. I'd worked in a hospital for a little while. And then I turned to my father and said, who are the people that you see we lived in Cambridge at the time. Who are the people that you see in your environment that are having the best sort of work hard, play hard balance, the best life? So in other words, if you had your time again, he was a bank manager, what would you do? And he said, the property guys are always really enjoying themselves, but working seriously hard. So that led on to working for one of those friends of my father. And then that led on to going to what is now university at Bristol, was Bristol Poly then, and doing an estate management degree. So a relatively straightforward way into real estate through that degree. Also gave me the opportunity to meet 7 or 8 of my best friends in life, living together in a house. So that was fantastic. We're all learning, as you do at that age, about life, but also bits and pieces about real estate. And that kind of led into what used to be the old graduate round. So led into a job at a place called King & Co, which became King Sturge, then became JLL. I was there for a couple of years. I did what kind of helped me later in life, later in my career. I started in valuation, which is basically the nuts and bolts of this industry. And then after about a year, moved into leasing for what was industrial leasing. So this is gritty, East End, Silvertown, industrial leasing. So some interesting stories I reflect back onto in that period of my career of learning, of being given responsibility early and then learning from successes or mistakes at that stage. After about 3 years, then the brother of one of my uni pals, actually Ian Warboys, who you've had on the pod, asked me to join him at Stratton Parker, a superb place to work at the time, an immensely fun place to work. We worked hard, we play hard. We were leading in certain bits of our industry. Back then, business parks were coming over from the US. We were working with the then leader Arlington in developing those parks around the UK, and that that involved development, leasing, and then assisting the investment guys with selling on the product. So just kind of evolving. That early part of my career was nuts and bolts valuation, then beginning to work out how you influence people in either leasing or advise them on development. And all this kind of helped later on, because if you come in from a investment banking background, I don't know necessarily whether you've always got those nuts and bolts which help. So slowly but surely things evolved at Struts, and eventually I got involved in the. We went through some cycles, by the way, and some trends changed. So slowly but surely, business parks probably weren't as successful or top of the list as maybe we expected in the early 90s. But slowly but surely, I got involved in Europe and taking some of our investment clients to Europe. So best example at that stage was Standard Life, beginning to invest in France, beginning to invest in Spain, beginning to invest in Central Europe. So, going back to Prague, for instance, with one of the Standard Life guys trying to find a way around Prague when all the tube signs were in Czech. Well, there's no English in those days. So some challenges going to Poland when there were no motorways. I think probably they were building the first one. So trying to work out where the logistics nodes were going to be in markets like that, but also going to Madrid, which, is a fantastically vibrant market that I'm involved in work there now. Fantastically vibrant market back then. And just sort of trying to bring, with the partners we were working in Europe, bring UK capital, institutional capital into Europe. And that kind of led to the transfer. The agency world used to call it going to the dark side. So I swapped from being an advisor to being a client.
But you did that after 16 years at Struts, if I'm not mistaken.
Yeah, look, the last 4 or 5 years of those were move into Europe, spending some time in the States, learning from the advisors that I met in the US and Canada, one of whom I had lunch with last week when he was over for Expo. So, and making some lifelong friends that are still relevant in my current role. I guess one of the things you need to reflect in your career is when you've spent a little bit too long somewhere. And I probably spent a little bit too long at Struts. Nothing against the people who ran Struts. I should have made a decision earlier. And I think if I give people advice now, is particularly if you stop learning, then you need to do something about it, because you will stagnate. So either change role or, if necessary, change job. And while taking into account all the risks and potential rewards of doing that. So through an old contact, an ex-Struts guy who'd moved to a group called Baring, Houston and Saunders, they offered me a role running international separate accounts, the principal one being ADIA. So I jumped to the client side and started running those separate accounts. We also had a very early Sharia account in those days. Really, when trying to do that in Europe, when you're trying to explain what that actually meant, and the fact that logistics was probably the ideal sector was fascinating.
And for someone listening to this who doesn't understand Sharia compliance or kind of the rules and regs around Sharia investment, what you can and can't invest in, can you just elaborate on that?
Yeah, look, ultimately it's Sharia law, which makes investing, for instance, the best example I used to give to the people in Europe when we were discussing this was alcohol is illegal in any of the investments that they make. So if you've got a shopping centre, for instance, in Finland or Sweden, where the alcohol outlets are all run by the government, if you've got a shopping centre with one of those alcohol outlets, you can't buy it. I mean, there are
like
ways,
betting and strip clubs and leisure and other kind of things fit into that.
All the things you would imagine are off limits under that religious Sharia law affect the strategy. and I say logistics, but yes, if it's a logistics warehouse for a booze supplier, then obviously not going to buy it. But you've got a lot of scope in certain sectors. So and look, that I had moved across to do that role, and at that moment, you try and plan your life and you try and think ahead. But then I had a health blip, which I've been fairly vociferous about recently because I've had my 20th anniversary of that health blip. I went to a standard doctor's health update, blood test, etc. Came back with a high PSA. At that age, I was late 30s. You feel pretty bulletproof, and as guys particularly, we try and kind of ignore issues like that. But I had a very, very good consultant who wouldn't leave me alone, and it ended up with biopsies and eventually sitting in front of a doctor who told me I got cancer. That's not a moment you want in your life, I can promise you. It's an interesting one, tough one. But and this is kind of the synchronicity of life then came to the fore. The guy that I had what's called a radical prostatectomy, which they take it out. It's probably what's called radical because it's basically
It's very radical,
taken away, and that then kind of hopefully guarantees that it won't come back. I was fortunate it was called early, but the guy that an eminent surgeon as he was then, Professor Roger Kirby, he did that operation, is still a great friend of mine, and the two guys I met in that hospital are still great friends of mine. And this is what I mean about synchronicity. Later in life, 20 years later, Roger was able to help my daughter into the industry that she's now in. So that's kind of just the way life goes if you keep your connections and you make friends along the way. The other main thing I also learned about that period is how the people around you, from my wife, my family, but also the senior people at Baring, Houston and Saunders, which by then was ING Real Estate Investment Management, how they gave me the time and the support to be able to recover. And they did that in many ways, but it was it showed me, and look, I've had the opportunity to do that to people who've worked for me since, to make sure that that person gets all the support, be it financial, be it care, whatever it requires to recover. So look, then life moves on.
Before we get on to life moving on,
Yeah.
you touched on a couple of things. One being, late 30s, probably feeling quite bulletproof.
Yeah.
Two, Stratton Parker being there for quite a long period of time, transition into Europe.
Mm-hmm.
And then, what I'm keen to understand is how your perspective changed post-diagnosis and operation on the importance of your personal life, wife and two kids, but also your outlook from a professional perspective as well.
Gosh, that's a large and rounded topic, but personally, make the most of your life. You can get too carried away with that because life is complicated and there are blockages and sort of bumps in the road. But yeah, make the most of it. Don't waste it. And then professionally, just care for the people that work with you, but also work for you. That doesn't mean you need to be soft or hard or whatever terms people would use, but care for those people. As one of my colleagues, when we were running ING Real Estate Investment Management in Europe, which I'll get to in a minute, we had 550 families reliant on our decisions, and that's the way we used to think about it. If we get this wrong, that affects those families. So we need to get this as right as we possibly can and think hard about it.
What you've said is kind of probably externally facing in terms of the impact and the kind of the wider impact that you're having on families. But what did it do for you personally in terms of your decision making from a professional perspective?
Well, I had quite a big decision to make soon after that, because the guys in London at ING asked whether I wanted to go and run a business in Holland. So, I joined that group in the UK with a European vision and with a European view, and they said, okay, let's take that and move you to the Netherlands, where the HQ was and still is for that company, and we'll get to that evolution in a while as well. But so I went to talk to the then CEO, who I ended up working with for 9 years, pretty successfully, and then turned around to my wife, and our kids were 6 and 3 at the time. Turned around to my wife and said, right, I might have to drag you out of Chiswick and Chiswick High Road and plonk you in the north of The Hague. Our office was in The Hague at that stage. Plonk you in the north of The Hague and change our lives, change the perspective of our lives. Looking back, it was a great decision for all of us, I think. It took a while to settle down. I was working extremely hard. My wife settled down eventually. Once she's pretty sociable, so she met people pretty quickly. But again, it's you're moving from a life in London to a relatively expat-centric life. Obviously, it wasn't for me at work, but outside it was, because we didn't speak Dutch. Dutch is a tough language to learn, and so we had to evolve and adapt into that. It also taught me that kids are incredibly adaptable. Our kids have been that in a way was the least of our worries. But yeah, reflecting internally without getting too heavy about it. It also taught me that I'm pretty resilient, that I can deal with things. It doesn't mean I don't worry about them, but yeah, pretty resilient and can handle change relatively well. As I say, without getting too heavy about it, we all reflect on ourselves and our paths and the decisions we made. But that was the main reflection, was you can deal with a lot and get beyond it, and then actually thrive beyond it.
Did that have any bearing on the private practice world and Stratton Parker, the kind of the institutional fund management piece with the European exposure, through to, we'll probably come on to it, but the capital advising piece, back to kind of being a CEO of a private business? You've worn lots of different hats, as I kind of touched on at the start of this. Is that kind of linked to maybe that diagnosis in terms of that invention and ability, and life is short and you can achieve, yes, you've got the self-doubt, but if you kind of put your mind to something, you can achieve it, and the insatiable appetite to be curious and push yourself and learn? Did that factor?
Yeah, look, the key bit of what you just said, I think, is keeping learning. And whether it's learning about real estate in other countries, or it's learning about cultures, whether it's learning about the view of an investor looking at the real estate market compared to an agent or an investment manager. They're different seats with different views, with different targets, with different requirements, and having revolved around that helps know or try and understand what the view of each one is in a situation. I mean, I'm not saying that everybody has to follow the path that I've followed. People do extremely well in this world doing one of those things all their career. But the fact that I have changed seats around the table, so to speak, has given me a broad view on the way our industry works.
Property is a people business, hence the name People Property place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. So tell me about just some of your reflections and learnings from your time in Europe.
Yeah, look, we, as I alluded to earlier on, I think we were at the forefront of things in kind of 2005 to 2008. We were setting up, we were investing in 17 countries, 13 offices. We were setting up the governance around investment committees that hadn't really been done in Europe before. So we were working, we were kind of leading the world into that, Europe into that institutional structure. Look, as we alluded to earlier on, the world throws bumps in the way. This was rather a large one in the global financial crisis that started in the UK and then slowly worked its way into the US and Europe in 2008. So we then have, globally, we were the largest real estate investment manager at that time. So ING, a Dutch bank, has the largest real estate investment manager. So the Dutch government, who's just given a bailout to ING, eventually, it took them 2 years, said, okay, you need to focus on being a bank, you need to divest certain assets, one of which was us, which was the real estate investment management business. And so we had a fascinating year in 2010, basically being sold by the bank, but obviously the management of that group had to be ready to go with the business. So we had a week in New York meeting the 5 biggest suitors, the 5 leading suitors. That made me reflect that 10 years before I'd been at Struts, putting my toe in the water in Europe. So you kind of sit back sometimes and the imposter syndrome sort of breaks out and you kind of sit there going, really? I'm in New York selling the part of the largest investment management business in the world. So kind of weird. But anyway, we then concluded the sale to CBRE and became CBRE Global Investors, as we were called then, now CBRE Investment Management. And proceeded to one of the other things actually I was going to cover at that time was, before that deal was done, we had to cull the team because that was part of the deal. And that's a hard thing to do, hard thing to make choices. I talked about 550 families and dealing with, keeping the business successful and growing with them in mind. Suddenly you're on the other side of that equation thinking, okay, we need to right size this business for the GFC and for a large corporate transaction that we're in the middle of. So yeah, look, there are all these other things to deal with when you're going through that period. We then, coming out the other side of it, we had to integrate 2 businesses, CBRE as was, and ING Real Estate Investment Management. The 3 of us that were leading the ING version led that business at the time. Fascinating period, very challenging, watching a European culture face up with a very West Coast American culture, and the slightly more, I don't know, I was going to say the word rounded, but the slightly more European caring version against a pretty straightforward financial model of the US. It's pretty much a private equity business, a listed business.
But more ruthless.
Yeah, ruthless, but in a very sensible business environment. So I'm not being critical of it. I'm just saying it's two very different. And you see it in the world today. The US attitude to the world and the European attitude to itself are very different, and they were then.
And I get a lot of that in terms of when I'm talking to people looking for new opportunities and jobs, and it's often people with young children, who are considering new opportunities, talk about that they don't want to work in a US private equity style environment just due to kind of maybe the hours and the expectations, and they would rather maybe a softer, rounder, more European type environment for that age and stage that they find themselves in.
Look, what do we talked earlier about learning and continuing to learn. And I'd done a few years at CBRE GI. And as the CIO in EMEA, I could see that we needed 3 or 4 products. So we had a growing open-ended European core fund, which is now the biggest in Europe, but then was, in its early evolution, probably got to about $1 billion AUM by the time I left. We had a very good logistics portfolio, which was in 2 funds, which eventually got melded together and is now one of the biggest open-ended logistics funds. We had some living strategies in Europe, and we had some big separate accounts. Now, when you sit back as a CIO and go, what else do we need to do? Because those are look like the 4 strategies that are going to succeed in the future. What else do we need to do? And when you're a large investment management group, the bar is high to make a new product successful. I mean, it's somewhere between 750 million AUM or to $1 billion to make the right profit level to make it worthwhile with all the costs you've got underneath. So you've got to launch a product thinking, okay, in reality, we've got to get over $1 billion. So let's try and make sure we only launch products that do that. That's quite a tight environment to sit in. Anyway, so one way or another, I decided I wanted to go to do something in a smaller group. And, we'd made a bit of money out of that, the buyout from CB. So I decided to join a global capital raising partnership called Hodes Weill. David Hodes and Doug Weill remain great friends of mine. They are leaders of the industry, and they do all sorts of market leading things. And we did during that period. So I went from a corporate role, leading an investment committee and all the other bits and pieces that a proper CIO role entails, to being one of 5 owners of a business of 35 people around the world. So New York, London, Hong Kong, and talking to capital around the world. Okay, I was running the EMEA piece, but we were meeting all the clients that the firm had across the globe. Seeing, and some might say, okay, you were kind of seeing that slightly harder edge of the US industry, but then you jump into a partnership with people that have basically come out of that background. Yeah, look, there are differentiations in all things in life, and David and Doug and my other partners were a very good differentiation of that American style. That period, I mean, I was a partner there for 5 years. Obviously, we had our own equity in the business. We started every year with 0 on the slate, so there's way more risk, which is kind of one of the reasons I did it. But it gave me the opportunity to be at the forefront of some phases in the industry. So, for instance, we raised some capital to do corporate take minority stakes, so minority stake corporate shares in asset managers. But we were doing that in 2016, 17. The market really bit into that in 18, 19, 20, and it's doing it again now. The consolidation of that squeezed middle in the real estate industry. We were doing it slightly earlier than the market had kind of, and it made it harder because we were early. We were at the forefront of life sciences in the US, the forefront of data shells. So we were doing this in 17, 18, 18, 19, when, it's really at the forefront of the industry now, or has been for the last 2 or 3 years. House building coming out of the GFC in Europe, things like that, just trying to pick sectors and seeing trends that would allow us to raise capital for clients. One other reflection on that time, I was exposed to some of the best real estate investment managers I've ever seen. I won't name names, but some of the US groups, global groups, and we would take them to, from Kuwait to East Manchester, or to Cologne, or wherever we were, taking them to see capital sources. The best of those managers, and these were some pretty heavyweight corporates in the real estate world, you wouldn't know the difference between them being in front of KIA in Kuwait or a smaller UK investor. Exactly the same investment discussion, investment performance, and respect for the person on the other side of the table. It's very impressive to see when you know the gravitas of your client. And again, I learned a lot from that. The professionalism of that, but also the ability, anybody who's done any traveling for work knows how, some people might think it's glamorous. It's not. It's bloody hard work. And seeing how those people dealt with that, and we had to deal with it as well, but seeing how those people dealt with it and just were very polished in all the meetings we took them to, incredibly impressive.
It's, obviously right now it's a challenging capital raising environment for most. What do you think are the key things that distinguish that kind of top quartile or top percentage of firms that are able to raise capital in comparison to the rest?
A myriad of things, but it's a complicated mixture. But fundamentally, they need to have a very, very good idea, a market leading, a differentiation in whatever they're doing. It's either a new idea that they have got enough experience in. Let me give you the example of the Data Shells Group. I won't mention their name, but we were 4 people coming out of a REIT. But there weren't many opportunities to get into data centers, data shells at that time. So as I say, this is around about 2018. It was basically a startup. But for that startup, because the idea was good, the people were very polished, very, very detailed knowledge, we were able to raise 600 million in 9 months. So that's the sort of thing that can differentiate. So that's kind of a combination of professionalism and subject matter. I think, look, the days of a large, multifaceted, multi-sector investment manager, unless you're one of the top 8 in the world, but say you're not, if you're one of those multifaceted, multi-focused investment managers, it's a tough world out there, because they are looking at the most impressive businesses in the world and comparing you with them. So somehow you need to differentiate with ideas, with experience, with track record, whatever it may be. I'll give you one other example. We did some work taking again a large American group around the world. They were at the time on Fund 8, so they'd been around a long time. And when you sat down with them in a meeting, and I remember being in one of those Middle Eastern countries, and somebody said, well, by the way, you're on Fund 8, funds 1 to 7 were pretty good, but Fund 3 isn't. So what went wrong there? What I learned was that the weak point in any chain is the bit that investors will pick up on. And there we built a very good story around that. It was ultimately the GFC, so that had caused that underperformance, and therefore their underperformance. I mean, this is a 1.3 equity multiple when everybody else or a lot of other investment managers were sub 1 in that vintage. You know, you just need to be ready for those tough questions sometimes. So that the professionalism, the preparation. Sometimes people, and we've seen a lot of this over the last 2 or 3 years. Sometimes capital raises don't succeed. I was reading one the other day that had been canned. So somebody that came out with, again, I won't mention the manager, but they came out with a capital raise 2 years ago, and they've given up because ultimately it's a very differentiated world now.
Yeah, I hear it all the time, especially on this podcast. In terms, people refer to it as the barbell. The bigger firms, hoovering up the majority of the capital, and then it's almost being a stock pick with the smaller entrepreneurial platforms where managers or capital allocators are looking for access to particular sectors in particular regions, and will go to kind of specialist firms to do that. Yeah. But there's that piece in the middle, that squeeze middle, who, have maybe been all things to all people and have struggled to define their USP and route to market and how they can generate alpha, and fees are getting pressed, and there's wage inflation, and there's other headwinds that they're combating, and suddenly, they have to find themselves in a position they're going, like, what is our angle? What is our route to market? What is our USP? How can we be competitive and generate alpha in this space? And I see it time and time again from people who find themselves in positions where, everything is downhill from capital raising. That they look to the leadership team and they think it's not coming, and actually it's an opportunity to maybe look at something else. So
look, one of the most impressive things, and look, I've had to do it myself, so I know how hard it is to run a business while you're also out there capital raising. So we used to use the analogy of spinning plates. When you're really, really, really busy and you've got to keep all these plates spinning, you've got to keep the existing business spinning, you've got to raise capital, you've got to think of new ideas, you've got to work with research and strategy. You're spinning all these plates, and you have to watch all those plates and spin them a little bit to keep them going at the same time. It's hard. So look, at the end of 2019, I exited that partnership. I sold my share back into the partnership.
Good timing.
Luck, I promise you. And look, David and Doug have done very well since. So that business is in decent shape, and they replaced my role with a very strong candidate. So as I say, the world moved on. And look, personally, my mother had just died. My father was on his own. I spent some time with him. My sister was doing a fantastic job looking after him. I wanted to do some traveling. We went, my wife and I and friends went traveling in the Caribbean, sailing the Caribbean. I went to Nepal for a month to find myself. No, I wanted to go to Everest Base Camp. So spent some time there, got out just in time, literally the day of the lockdown. I had to come back from Nepal a day earlier, otherwise I'd been there for an awfully long time. And then had been talking to GSA and joined GSA not long after I came back from those travels, when the world had basically shut down with COVID. But I mean, this goes back to fundamental need the GSA business is based on the fundamental need for student housing around the world. They're very good at doing the investment side and the operational side, and continue to expand based on that fundamental need for accommodation and the growth in student numbers around the world. I went in and ran the investment management part of that business for just over 18 months. It's a tough time. I spent quite a lot of time in the US because we're expanding there. Very intense period, and enjoyed it immensely. But yeah, we were spinning plates. And one thing that taught me is operational real estate, that everybody says is the nadir at the moment. The operational part of it is hard and needs scale and needs very strong systems for it to function well and to make money. So it's a wonderful investment strategy to have in a theoretical sense, but very difficult to put in practice. That's why there are some very specialist investment manager operators within it. At the end of that period, I then left GSA and decided I wanted to run my own business. So I'd set the company up a couple of years before, and so I activated that. And I suppose took some of the learning from all that we've discussed into advising some of the operational focused, very specific strategy businesses that I had got to know through old contacts, or however the relationships came about. And that now spans UK housing, European student, European co-living, and also logistics, European logistics. So beds and sheds. I've done some work in life sciences with a very good operator, and I've done various other bits and pieces of strategy work for a number of other clients. So the variety of what I do now is the special sauce for me. I really respect the people I work for. I mean, that has to be a mutual relationship, otherwise it doesn't work in the first place. And fortunately, those strategies, in what's been a pretty tough world from the beginning of, Ukraine war, all the awful things that have carried on from that, but the inflation, and then the rise in interest rates and swaps that caused, has made real estate drop down the pecking order of allocations. Again, going back to Hodes Weill, they do an allocation survey. I don't think there's a better one out there, but they do it every year. And for 7 or 8 years leading up to COVID, real estate was number one to all the institutional answers they got back. Now it's not, and it's working its way back up that league table. But the increase in interest rates, the losses that were caused by the buying spree that went on between 18 and 21, and some people got out in 18, 19, 20 and 21 and have made a very tidy profit out of whatever they've done. I've got some friends who've done extremely well out of that period, but most didn't sell at that time. And so when interest rates moved out, obviously property yields move up, values go down, and there's a bit of blood in the water. With the right strategies, we've been able to raise capital during that period, but it's been a pretty difficult period for many other industry parties who it's almost like pedaling the same old bike in a way. Bad analogy, but and we've gone we've gone into a period of consolidation, caused by the need to get bigger, but also caused by some of the models, particularly the private equity model
Buy, fix, sell,
promote.
buy, fix, sell, 3,
Yeah,
5, 7 year type
yeah,
investment periods.
but also the promote model. Okay, I'm sure the people in the private equity industry aren't paid badly in a global sense, but the big win is the promote. And if you're sitting in a promote model that didn't sell in 21 and waited to late, mid 22, that model is underwater and is probably not going to be above water for a long time. So how do you deal with that? Some of the M&A that's happened since since there was light at the end of the tunnel, which I guess was the end of 23, beginning of 24, some that's happened since then will have been driven by that. Nobody's told me that. It's just I believe that's why it's happening. So yeah, it's interesting to see the industry evolving again. Just one other sort of an old sage in the industry. Again, I won't name them, but somebody very involved in the private equity cycle said, look, there are in each cycle, which is say it's between 7 to 10 years, there are about 2 years to make outsized returns, be that corporately or be that in that investment transition. And if you don't hit that, it's not a cliff edge either side of those 2 years. It's a gradual slope, but that's the peak, 2 years. So you've got to be very, very smart, very savvy, and very specific to hit that.
What do you think LPs or kind of capital allocators' take is on real estate as we sit here today in October 2025?
Mm-hmm.
Because a number of people have been calling the bottom of the market for a number of years now, and they've been saying that probably that two-year window to strike is now. What's your take, and what's your take from the kind of conversations you have with LPs looking to kind of allocate capital into real estate?
Look, I've written various things on LinkedIn about the state of the market over the last 12 months. It's no secret that for those larger PE groups that have capital, they've dominated the last 3 years, because, call it bottom fishing, whatever you want to call it, but it's a mixture of pricing, it's a mixture of consolidation, agglomeration, but that slice of the capital world has been dominant. Beginning of this year, I thought it would happen earlier, so I was one of those kind of expected that from early 24, the core plus capital would begin to return to the industry. It's taken longer, I think, basically because of the denominator effect and some of the other aspects that take time to work the way out of the market, out of the system. It's just taken longer for that to evolve. But I'm beginning to see some of the institutions who are running a fully rounded investment portfolio, and real estate can be seen as the last door down the end of the corridor. It's real assets now, so it's probably the last 2 doors.
I was going to say it's that kind of merger between real estate and infrastructure.
Yeah.
In that combination of real assets, especially with the rise of data centers, powered land, cheaper costs of capital with infrastructure, making it more accretive. There's that blurring. We're definitely sensing and seeing that with the clients and the work that we're doing.
And look, that makes huge sense because it is blurred. I don't know how many different titles I've heard of for CEOs of groups, real assets, real estate, infra, whatever. But it makes huge sense because they all feed from one another. I mean, the infra world is doing incredibly well from a capital raising standpoint. partly because the amounts required in large infrastructure projects require huge amounts of investment, huge amounts of capital. So recently there was a 20 billion raise, around infra, and I think some of the larger PE groups have done way beyond that. So that real estate, if taken on its own, pales into in not quite insignificance, but way smaller capital raises. But I'm beginning to see that core plus capital come back into the market, very selectively, tending to buy underpriced assets where the valuations are recovering but are nowhere near their 21 levels. I mean, we're very unlikely to see 1% interest rates or 0% interest rates again in the medium term, short to medium term, if ever we do. So there's some of that capital coming back into the market, and that's basically driven by capital allocation across some of these insurer pension fund groups that are looking across equities, bonds, etc., and then realizing that actually probably makes sense to go back into some of these markets.
What's your take on continuation funds?
Look, ultimately they are a product of the stage of the market, and those funds have two choices. This is, in my view, those funds have two choices. You either trade out at a loss, or you kick the can down the road. And I think that's basically what's happening. Okay, the derivatives within that broad statement, but and ultimately, if you sit down and think of the component parts of that, you've got investors looking at a potential loss, you've got managers looking at a track record that's going to be dented or critically hurt. And if you can continue and maybe the fees are lower, the terms are better, then that makes sense for everybody. So look, it reminds me a little bit of some of the extended pretend that was going on with the banks after the GFC. Should we take this loss, or should we let these guys run it for another 2 or 3 years, and maybe the yields will improve and the values improve, and we'll get out of this mess. So it's probably a bit brutal, but that's my view on it.
What are you most excited about right now as you kind of look out across the market, and where do you think the opportunity is?
Well, one thing's very clear in this world, and look, I've got to be avoid being too self-serving here, because I've stuck with beds and sheds in principally in what I've done in the last 3 years, but fundamentally people need somewhere to live, and they're ultimately then need goods, services, things for where they live, and those need to be delivered. So the world has realized again that living is very living and beds within it, and all the derivative parts of that. So all the way, I remember talking to one of the guys in the States in one of the largest, and I think they probably are the largest operator of beds in the world now, what their business plan was. And he said, well, it's providing rental housing from 18 to 80, Will. It's as simple as that. So I'm excited about that, because I think there are opportunities for value creation and within single family rental, PBSA, co-living. I haven't really been involved in senior housing because I understand the demographics clearly, but I think the model needs to mature a bit further. And then logistics, be it urban to big box, still continues to be in demand. Okay, there are fluctuations within Europe, but if you're playing in the European theatre, the country differences, the urban to big box differences are, each market's at a different stage of evolution, oversupply, undersupply, wherever it may be. So that there are opportunities there. And look, the data center side of the market, you see some of the large logistics groups moving into data centers, extrapolating their model. That makes sense as well, because fundamentally, if you've got a piece of land with the power and the connectivity, then yes, it might be wonderful for logistics, but it's a lot more valuable from a data center or data shell point of view. So those are the sectors that I'm focused on principally.
Through your advisory work with Node and Brick Lane and Panettone and other platform
Yeah,
groups.
ultimately, and I've also done some work around that for other groups. And the thing, going back to 20, 25 years ago, dealing with Europe, if you look at PBSA in the US and the UK, is very mature. But if you look at it in Germany, in Italy, Spain, it's maturing quickly. But if you look in in some of the European locations, there's tons of work to do there. If you look at, we had a meeting last week looking at one of the living sectors in Spain, and it's just nowhere near as mature as it is in the Anglo-Saxon world. So there are opportunities in that geographic European model.
So it probably ties into a kind of a final question and a tradition we have on the show, which is, if I gave you £500 million worth of capital, who are the people, what property, and which place would you look to allocate that capital?
Well, if you'd asked me 6 months ago, I'd have put it all into AI stocks and done very well out of it. I'd probably have got out of them by now with all the noise in the world.
Depends if there's a bubble or not, right?
Yeah. How many times do you read bubble a day at the moment? With the risk of repeating myself, I think that the people I work for and are exposed to in those sectors is probably where I'd put the equity. I think developing into undersupplied markets, developing in living has been very, very difficult, particularly in the UK. But developing into living or taking over assets from housing developers that, so you remove the development risk angle, you basically are a mature professional landlord for the people that want to live in those houses. I mean, the demand is huge. Demand is everything that is being produced, everything of quality that's being produced in the right markets in the UK lets within a month. And, that's a market rent. Okay, so this isn't affordable, it's a market rent, but it's a sensible market rent with a professional landlord providing the right services and, 3-year leases. So we need to get away from that. I mean, I couldn't work out. When I went to Holland in 2005, we had a 2 billion resi fund in 2005. That doesn't exist in the UK. The market was it felt to people in the UK like it was very mature, but it wasn't. Ultimately, it was way mature in continental Europe. And that professionalism needs to be driven into all the living markets across whatever rental sector you're talking about. So that, and as I say, developing into undersupplied markets and logistics, or where you can, acquiring assets at below replacement value, that's harder. That's more opportunistically driven. And that, again, you need a European-wide view to be able to do that. Can I just add one more thing? One of the biggest joys of having been around for quite a long time is having worked with young people. They've either worked for me or they've worked for clients, and watching them succeed in the industry, and to achieved by either taking risk or taking large corporate roles, but just seeing them learn the lessons that we've all learned when you get to my stage of your career and then succeed. That's a fantastic thing to see. And, I've got various WhatsApp groups of people that work for me, wherever it may have been, but to see the people that are very capable make the most of it is a fantastic thing to watch.
Well, Will, you've had a fascinating career. You've been able to reinvent yourself across lots of different job types, institutional types, geographies, and I'm excited to see the work you do through the portfolio companies and the impact that you have on their businesses, and also see where the market goes and how the opportunity presents itself for all of us. So thank you so much for joining me today. It's been great to hear about your background and story, and I really appreciate you sharing some of your lessons, reflections, and thoughts. Can people find you on LinkedIn? And if so, where?
They can find me on LinkedIn. Yeah, Will Rowson. They'll find me. There's enough content on there, so they can find me there.
Great. Well, Will, thank you so much for joining me today.
My pleasure. Thank you very much.
Hey, quick one from me. If you enjoyed this conversation, do me a favour and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.